Hello and welcome back to the Geordie Pig Investor channel. If you've clicked on this video, you've probably seen the recent share price crash with B&M Bargains. After getting loads of messages and requests about it, I'm here to break it all down, what's caused the drop, whether I think it's an overreaction, or if it might be time to sell as more trouble could be on the horizon. If you enjoy these stock breakdowns, make sure to smash that like button as it really helps me out and lets me know you want more content like this. And if this video hits over 100 likes, I'll keep posting more deep dives and updates on dividend stocks right here on the channel. First of all, let's have a brief look at what the stock is in case you're not familiar with them. B&M Bargains, stock ticker BME, is a UK-based discount retailer that sells groceries, home goods, garden items, toys and seasonal products at low prices. The company operates over 700 stores across the UK and has expanded into France. B&M also owns Heron Foods, a discount frozen and convenience food chain which helps strengthen its position in the value grocery market. If we do take a closer look at B&M themselves, we can see they're priced at £1.79, have a market cap at 1.81 billion, went public in 2014, have over 39,000 employees, are on a 2-year dividend growth streak with a 5-year dividend growth rate at over 4%, and have a very high dividend yield that currently sits at 8.35%. Just over the last week, we can see that they are down close to 19%. This is actually after having a small recovery over the last couple of days, as it was actually down 24.29% on the 20th of October. If you like these UK stock analysis videos, then I've got an offer that you won't want to miss, as you can receive a free share of one of the best performing UK companies over the last few years. It's a stock I wish I had more of in my own portfolio, as it's up over 400% in just the last 2 years alone. That free share you will be receiving is a Rolls-Royce share. I've teamed up with XTB UK as they are currently running a pretty awesome promotion where new users can get a free Rolls-Royce share just for signing up. Yes, it's that simple. All you need to do is click my link in the description down below, download the XTB app, open an account, verify your account, make your first deposit, and then you'll receive a free Rolls-Royce share. Remember that your capital is at risk, the value of stocks may fluctuate, and there is limited availability and T's and C's do apply. But it really is that simple, and the best part is XTB isn't just a trading platform. It's also a solid place to learn. They've got loads of free investing education, as well as keeping you up to date with the latest market news. You can see here the interface is clean, beginner friendly, and gives you access to both UK and global markets. There's over 6,600 stocks available on XTB alongside 1,800 ETFs. Plus, if you're in the UK, you can even open a stocks and shares ISA account, which means your investments can grow completely tax-free. And you'll even receive an industry high 4.25% interest on uninvested cash. If you want to grab your free share, make sure and use my referral link in the description down below. Just remember, as with any investment, your capital is at risk. The value of your investments may go up or down. There is limited availability and T's and C's apply, so make sure you're quick. This offer is only available for a limited time, and once all the free Rolls-Royce shares have been claimed, that's it, they're gone. So don't miss out. Now that you're hopefully receiving your free Rolls-Royce share, let's have a closer look at why the stock has seen such a sharp price decline. The first reason why it dropped so dramatically was due to a costly accounting error. Last week, the company disclosed an accounting error as it failed to recognise approximately 7 million of overseas free costs following a systems update. I know, you'd think that £7 million wouldn't just slip under the net, but for some reason it did, and that's exactly why it led to the CFO's resignation. Michael Schmidt announced his resignation in the wake of the accounting error. This raised concerns about financial governance and oversight, so although it may look like a small governance glitch, I feel it may undermine investors' trust in management and financial controls, leading to higher risk premiums. And as a result of this error, you also had reduced full-year guidance. B&M reduced its full-year adjusted EBIT EBITDA guidance for the year ending March 2026 from about 510 to 560 million to now only 470 to 520 million. Which again is why it spooked investors, and then we saw that big sharp price decline over this last week. A wider issue is the broader discount retail sector in the UK is under pressure. Consumer spending by B&M's core low-income customer base is weak, margins are squeezed by rising costs such as labour, shipping and inflation, and competition is intensifying. This margin pressure and cost escalation suggests future profit growth may be harder to come by, which weakens the investment case going forward. And as we've already touched on, you also have the investor sentiment has turned negative. Given the earnings downgrade, the governance issue and the macro headwinds, the market has repriced the business to reflect higher risk and a weaker outlook. So as a result of all of this, the share price has plunged to multi-year lows, reflecting the severity of the hit to guidance and confidence. But for me, I believe for investors, the drop could represent a potential value opportunity if the business successfully executes a turnaround and restores confidence. Now, let's have a closer look at why I think it could be a great opportunity. First off, you've got the significant valuation drop. The share price has tumbled to multi-year lows, which may mean the market is over-discounting the business relative to its longer-term potential. The current price is the lowest it's been in over 10 years, and to me, this business has only gone forward in that time period when looking at it closer. You've also got the store expansion potential. B&M has outlined a plan to operate at least 1,200 UK B&M stores from its current numbers, plus growth in France and through its subsidiary Heron Foods. This really does give me confidence that the company is still within their growth phase. The low price value retail model has structural appeal when consumers are under pressure. If B&M can execute, that thematic tailwind could reassert. And for me, even in tough times, their business model appeals to almost everybody, and this time of year is also usually a very strong period for any large retail company, which is why I'm hopeful on their next quarterly results. And finally, we've got their room for improvement. With recent issues in the rear view, I believe the only way is up with the new leadership as long as the correct steps are taken. This will eventually restore confidence in the company, so I'll personally be keeping a close eye on who the new CFO is and how operations fare thereafter. I will say that if the new CFO can stabilise operations, then we will look back at this period and be in disbelief with the value that's currently on offer. When we come over to Stockopedia and have a look at their overall stock rank score, it's currently sitting at 52, which honestly isn't bad considering the recent drop. The most important score to me is always the value rank, and right now with it sitting at 95, that means the stock looks really attractively priced at these levels. It also still holds up decently on quality, coming in at 65, which shows the underlying business fundamentals are still pretty solid. Of course, the momentum score has taken a massive hit, and there's no surprise to see this is actually at the lowest score it can possibly be, only being scored at 1, but that is due to the fact that over the last year, we can see the stock is actually down over 60%. When we say a company's share price is down 60%, we are actually talking about the market value of the company. So this is what investors are willing to pay for the share. The key thing to remember is that the share price doesn't always reflect the day-to-day operations of the company. B&M could still be profitable, expand in stores and paying dividends. So although over the next few quarters it may not be 100% ideal, I still do believe if you are a long-term investor that right now this could be a fantastic opportunity. We can see the analyst consensus is that B&M is a buy right now, and they actually have 9 overall buys with 3 strong buys compared to only 2 sells. They also have a price target that's recently been adjusted to 298 pence, which would still be 73% above the current price. Something that I really do like to look at within a company is if the people inside the company are buying or selling it. When the insiders are selling shares, that's usually a bit of a red flag for me. But when they're buying, it instantly builds confidence because it shows they're putting their money where their mouth is. And in B&M's case, that's exactly what we've seen. Since taking over in June, the new CEO has been buying heavily, investing over £1 million of his own money into the stock. Honestly, After this recent share price drop, I wouldn't be surprised if he's planning to top up even more, and that's always a great sign for investors. Now we're going to get some valuations for the stock, starting off with my intrinsic value. Intrinsic value is basically what I believe a stock is really worth based on the company's fundamentals rather than just what the market is currently pricing it at. To work this out, I personally use a mix of the relative valuation method where I compare key ratios like the PE ratios and PS ratios against similar companies, and a discounted cash flow valuation which estimates the present value of the company's future cash flows. By combining both approaches, I can get a clearer, more balanced view of what the stock should be worth. In the case of B&M, this helps me decide whether the recent share price drop has made it undervalued and potentially a great long-term buy compared to its intrinsic value. When I calculate intrinsic value, I like to take things a step further by running 3 different valuation scenarios, a worst case, average case, and best case, as this then gives me a realistic range rather than relying just on one number. And as you can see on my worst case price, they were valued at 419 GBX, which was a 57% undervaluation on the current price. On my average case, they were valued at 577 GBX, which is a 69% undervaluation on the current price. And on my best case price, we can see B&M Bargains were valued at 862 GBX, which is a 79% undervaluation on their current price. After looking at their intrinsic value, I then look at something called the Wall Street estimates. Wall Street estimates are forecasts made by professional analysts who closely follow the company. They typically include projections for things like future revenue, earnings per share, profit margins, and sometimes even target share prices. I use these estimates as a reference point to compare my own analysis against what the broader market is expecting. They help me see whether my valuations are more bullish or conservative than the consensus view. For B&M, looking at Wall Street estimates gives extra context. If analysts are still expecting solid growth and stable earning recovery despite the recent sell-off, it adds confidence that the market may be overreacting and that the current price could represent a strong buying opportunity. As we can see on their lowest forecast, they are still quietly optimistic with a 57% upside being valued at 282 GBX. On the average price being valued at 422 GBX, which is a 135% upside. And on the best case scenario, they believe over the next 12 months that B&M could be worth 630 GBX, which would be a 251% upside on the current price. Now that I have all 3 valuations, I can combine them to get my final best, average and worst case scenarios and see if B&M Bargains is at an attractive price. On the worst case, they were valued at £3.51, so with a 10% margin of safety, I'd be looking to buy the stock at £3.16. And with a 20% margin of safety on the worst case price, I'd be looking to buy B&M at £2.81. On the average case, they were valued at £4.99. So with a 10% margin of safety on this price, you'd be looking to buy them at £4.49. And with a 20% margin of safety, you'd be looking to buy B&M at £3.99. And finally, on the best case price, we can see they were valued at £7.46. So with a 10% margin of safety on this price, you'd be looking to buy B&M at £6.71. And with a 20% margin of safety, you'd be looking to buy them at £5.96. So, are B&M a buy right now? Overall, based on the intrinsic value, analyst estimates and everything we looked at today, I genuinely think B&M Bargains is a fantastic long-term opportunity. Even on my worst case price with a 20% margin of safety, they are still valued incredibly well right now. In fact, I don't think I've seen a company on this level of a discount in a very long time. Even if they were to cut their dividend down, I'd still be very confident in them long term. The company's fundamentals remain strong and I don't see them going anywhere anytime soon. So as long as the new CFO actually knows how to do maths, unlike the last one who clearly struggled with a calculator, then I feel the business will keep expanding across the UK and France. So that wraps up today's breakdown on B&M Bargains. If you enjoyed this video and want to see more UK stock breakdowns like this one, make sure to drop a like and subscribe to the channel. It really helps me out and lets me know you want more content like this. Also, let me know in the comment section down below which stocks you'd like me to cover next. I always read through your suggestions and love hearing what you're watching. Thanks for tuning in, and for now, this is the Geordie Pig Investor, over and out.